You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me in the studio today is me. I've been involved in the options industry for over 25 years, and as I'll be presenting an upcoming OIC webinar detailing the nature of corporate actions and their potential impact on options, I thought the topic would also make a great podcast. So here we are. As many of you know, options are defined as derivatives as they derive their value elsewhere, whether it be from an underlying stock, an ETF, or an index. And when a corporate event such as a stock split, merger, or bankruptcy affects the underlying, it may be that options become likewise affected. So that being said, there are any number of corporate actions which might affect an options contract, and adequately dissecting each would require significantly more time than allotted for a single podcast. However, OIC's website at optionseducation.org offers a terrific FAQ page dedicated to corporate actions, as well as several videos and on-demand content detailing various corporate actions and their impact on options, not the least of which is my upcoming webinar where I'll be taking a deeper dive. So with that in mind, today's podcast will focus on three main types of corporate action: mergers, stock splits, and special dividends. Let's start with mergers. When Company A merges with and absorbs Company B, for example, Company B shareholders will typically left with either proportionate shares of Company A or, in the case of an all-cash merger, simply cash. In either case, option holders and writers investing in Company B will likewise be affected, and therefore the merger will likely necessitate an adjustment to the option. The decision to adjust options lies solely with OCC and is made according to OCC's SEC-approved bylaws, specifically Article 6, Sections 11 and 11A, which are available on our public website, www.theocc.com. I should also note that each corporate action is reviewed by OCC on a case-by-case basis, and like things most involved in the investment world, past performance is not indicative of future results. So let's look at two examples of mergers, those being one stock and one cash, and let's see how options might be adjusted. Let's assume that company XYZ mergers with company ZYX, and that as a result, XYZ shareholders receive 3/4 of a share for ZYX for every XYZ share that they hold. So for an investor with 100 shares of XYZ, they would now hold 75 shares of ZYX. Simple enough, right? But if seeing as how not only did the number of shares the investor now holds change, but the shares are for an entirely different company than originally purchased, it would be expected that XYZ options would change as well. Whereas the old XYZ option called for the receipt or delivery of 100 shares of XYZ stock, post-merger, it may be that the adjusted XYZ options include this adjusted deliverable of 75 shares of ZYX. In the event of a change to the options contracts, OCC would publish an information memo on our website detailing the nature of that change. In this case, it is likely that the trading symbol would change from XYZ to XYZ1, and that the deliverable changes from 100 shares of XYZ to 75 shares of ZYX. In this example, as the deliverable now is 75 shares versus 100, investors would need to do a bit of math when it comes to valuing their options, which is also explained in the information memos I had mentioned previously. In this instance, the investor would take the current stock price of ZYX and multiply it by 0.75, which represents the 75 share deliverable. If ZYX was trading for $100, for example, the effective share price for which XYZ1 options are based would be $75. So an $80 call in XYZ1 would be out of the money by $5 as opposed to being in the money by $20, which on the surface it might appear to be. I should note that any time an investor sees a numerical suffix attached to the option, it's an indicator that the option has been adjusted in some manner and that the deliverable is now something other than the standard 100 shares. Knowing this might help avoid confusion or inadvertent mistakes when pricing and trading adjusted contracts. All too often, we speak with investors here at the Investor Education Desk that erred in purchasing options at a too good to be true price, only to find out that the adjusted contract is worth far less than was expected, and that in fact, the contract was priced accurately to reflect the nature of that adjustment. If you have any questions about option pricing and or pricing of adjusted options, feel free to drop us a line via email at options@theocc.com or live chat with us on our optionseducation.org website. Now, let's assume that rather than shares being exchanged in the merger, this merger is going to be an all-cash deal instead. These scenarios are a bit easier to decipher as the final settlement value of the shares, and therefore the options also, are now known. If ZYX were to purchase XYZ for $75 a share, let's say, any call options with a strike price below the cash amount would settle for its intrinsic value, while out-of-the-money contracts would expire worthless. So a $70 call would expire with $5 of intrinsic value, or $500 per contract, while an $80 call would have no intrinsic value and simply expire worthless. I should also state that as the final settlement price is now known, any time value left in the option will automatically evaporate. For this reason, it is likely that all affected options will now have an accelerated expiration date, as there is no longer the possibility of future stock price movement. Remember that time value represents the possibility of that future stock price movement, and changes in implied volatility, etc., up until the contract expires and the final settlement value is known. Now that the settlement price is known and has been determined to be $75, there's no possibility that this number is going to change. It's now set in stone, so to speak. And as a result, all time value has disappeared. So if the cash merger for $75 per share was consummated in May, for example, we would expect that all affected option series accelerate their expiration, possibly to the June monthly expiration. In other words, if an investor purchased a January long-term LEAPS option, now that all time value has disappeared, that January contract would likely now expire in June. Now, let's shift gears and look at forward and reverse stock splits. Forward splits are generally easier to understand as they're more intuitive for some. For example, if company A calls for a 4-for-1 stock split, the investor's stock holdings get multiplied by the factor of 4, while the stock price is divided by that same factor. Let's say stock is trading $400 per share and that our investor is holding 100 shares. Post-split, that stock price is likely to be around $100, and the investor now holds 400 shares. Economically, there's no impact to the value of the holdings pre-split versus post. Both scenarios result in $40,000 worth of stock. Options would likewise and similarly be affected. To account for the split, the number of contracts an investor bought or sold would be multiplied by the split factor, 4 in our example, and the strike price would be divided by the split factor. So if an investor were holding, let's say, 10 $360 calls, the position then becomes 40 $90 calls. As an added note, as the deliverable of 100 shares per contract remains unchanged, the option symbol would likewise also remain the same. Reverse splits are a different breed altogether and therefore account for a large percentage of the questions that our team receives on a daily basis. Let's say that stock ZYX is trading for 35 cents per share and the company announces a 1-for-20 reverse stock split. As a result, shareholders would see their stock holdings reduced by a factor of 20, so 100 shares becomes 5, but the stock price increases 20-fold, up to $7 now. Where it might get tricky is that the number of option contracts remains the same, as do the strike prices. However, what does change is the deliverable, which is now 5 shares per contract, down from the original 100. In addition, as the deliverable changes, so does the option symbol, from ZYX to ZYX1. And remember that math that we talked about earlier? That comes into play once again. To calculate the effective share price, which was used not only to price options, but also to determine whether the contract is in, at, or out of the money. In this example, we would take the current share price of $7 and multiply it by 0.05, representing the number of shares delivered. The result is an effective stock price of 35 cents, which would be used for pricing, determining intrinsic value, etc. In this case, with an effective 35-cent stock price, any call strikes at or above this point would be determined out of the money, as would any puts with a strike price below this amount. If a call buyer were holding a contract with a $1 strike price and they decided to exercise, they'd pay their strike price times 100 and receive 5 shares of ZYX stock. In other words, they'd be paying $100 for 5 shares, or $20 per share, even though the stock is trading around $7 in the open market. This is where the effective share price comes in handy, as it allows the investor to make an informed opinion as to whether or not to exercise. With the effective price at 35 cents, a $1 call would be considered far out of the money. In order for it to be considered in the money, post-split shares would need to be trading above the $20 mark. Before we move on to the last topic, I wanted to mention just a few caveats in regard to corporate actions. Number one, post-stock split, it may be that the exchanges introduced unadjusted standard 100-share deliverable option. It's not out of the ordinary that investors might see both standard XYZ and adjusted XYZ1 option contracts trading alongside each other on their options chain. However, the contracts are likely to be very different from each other, as evidenced from the expected bid-ask markets. Let's say that XYZ underwent a 1-for-10 reverse split and that the shares are now trading $3 post-split. The options chain shows a market of no bid at a nickel for the adjusted $1 calls, while the unadjusted or standard $1 calls are being quoted 180 bid at 215 ask. Now, on the surface, a call buyer might think the adjusted contract should have about $2 worth of intrinsic value. So buying these options for a nickel would be a steal. Unfortunately, they're failing to realize that the effective share price for these adjusted options is reflecting a 10-share deliverable rather than 100. And as a result, the underlying stock price is closer to 30 cents rather than $3, and therefore the adjusted contract is actually 70 cents out of the money versus $2 in the money. Which brings me to item number 2. To protect unwary or unknowing investors from buying or selling options with other than 100 share deliverables, some brokerage firms may prevent their clients from trading adjusted options on anything other than a closing-only basis. Meaning, if you owned XYZ contracts prior to a corporate action, such as a reverse stock split, your broker may prevent you from buying additional adjusted contracts and might only allow you to close out your position through a closing trade or the exercise and assignment process. For more information on your firm's policies and how they might affect your trading, you'll want to reach out to your brokerage firm directly. So to wrap things up, and with what little time remaining that we have, I wanted to briefly talk about ordinary versus non-ordinary or special dividends. My colleague Matt Cashman provided excellent insight in last month's podcast and subsequent OIC webinar about all things dividends. But I wanted to highlight a few things before closing out today's session. When dividends are announced, the company paying the dividend will typically declare it to be ordinary or special. As Matt had stated in our last podcast, ordinary dividends do not warrant special treatment or an adjustment when it comes to the option. If a company declares the dividend to be special, OCC will review all relevant information in order to determine if an adjustment to the option contracts is warranted. The adjustment might include either a reduction in the strike price equivalent to the dividend or simply attach the cash value of the dividend to the contract's deliverable. If the latter, we would also see changes to the option symbol. Remember from our discussion earlier, if you see a numerical suffix attached to the option symbol, it denotes that the contract deliverable is something other than the standard 100 shares. And that brings me to a close of today's podcast. So a big thank you to all of our listeners and supporters out there. Before we sign off, I want to invite you to register for my upcoming OIC webinar, which will take a closer look at corporate actions, complete with downloadable slides to better help you visualize the concepts that we discussed here today, as well as several others. You can register on OIC's website, www.optionseducation.org, to attend the live presentation or to view it on demand. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Again, thank you to all those that are listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.